All right, so stock started off the week with another strong move, relatively to the upside, with another vaccine news. So, but as you'll see, the moves have been getting a lot different, and it wasn't a breakout move as much as they might say that was significant on TV. It wasn't a breakout. So I'm going to break down kind of the sideways action right now, what it means, where have we seen this kind of move before, especially with what's going on in small caps. Where have we seen this move before, and what can that tell us going forward from here? I also wanted to show you one quick thing before we get started. We are starting our Black Friday sale this week, going through to next Monday. Our Black Friday sale is 20% off of our premium subscription plan. You can see we have a premium and plus. Our plus subscription is our monthly subscription, $99 a month. Our premium subscription is for 3 years. It works out on average to be about $82 a month. So with 20% off, that works out to be, on average, again, over the 3-year period, $66 a month. Well off the monthly price. And in addition to what you get with the monthly, in the monthly you get the Market Outlook live video, you get all of our trading rooms. But in addition to all of that, with the premium subscription, with $33 less a month on average, you get, in addition to all the trading rooms, our 2 Q&A sessions that are for premium subscribers, our premium tools, including our trade alert, our trade alert service that we do. Whenever we do trades in between trading rooms, you get notifications on your phone of what trades that we do, opening and closing. As well as all the other charts and tools that we use in these videos and in our classes. And then you also get access to our class forums, where we do discussions with other class participants, and as well as any other original, unique content that we have specifically for those classes. So I just want to let you know, again, to use that coupon, you just click on that orange button up here at the top. That takes you to our premium page. You can read up on what other people have thought about their subscriptions there in this forum. And then you can come down here if you want to be able to pay over 6 months using PayPal credit. You can pay over 6 months with no interest. Again, that's subject to their credit approval with PayPal. But a lot of people are wondering, hey, I can't pay for the 3 years all up right now, even though it's a great deal. It's basically a third off of the monthly plan, and you're getting a lot more than what you get with the monthly subscription. So you get essentially a third off. But if you want to stretch that payment out over 6 months with no interest, then you can do so with following these instructions with PayPal. Just make sure you come here and you use the coupon code up here in the top, Black Friday, all one word, with a capital B and a capital F. Just stick that right there in the coupon code section. And then if you want to use the PayPal, make sure you check the PayPal button right there. Today is Monday, November the 23rd, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, we had a bullish day today. We're up 0.5%. But again, we stayed in the range. If you look at last week's range, last Monday's range, including the overnight session, we've stayed in that range for the last 2 full weeks practically. Well, now 2 full weeks when you include today. So now we're kind of going on 3 full weeks through this Thanksgiving holiday. So up and down, don't get worked up. That's going to be a recurring theme, and has been, and will continue to be a recurring theme. I know, I heard at the end of the day, I heard on TV, it's like, we had a really good kind of a breakout day today. And it's like, now some stocks did. Some stocks had some individual moves. Financials and things like that. Energy had a really good move today, but to say we had a really big breakout day today when we've been stuck in this range for 2 weeks is, you're kind of trying to drum up some interest, because there's not a whole lot of interest in sideways action, and for that matter, we've been sideways for 3 days. So keep that in mind. The intermediate posture is declining because we're not going up anymore, but it's not declining rapidly because we're not falling. So it's just kind of going sideways. Well, that suggests that we could get light pink shading here soon. It wouldn't be the end of the world. The near-term line's still below 50. It's been below 50 now for 4 days. So the rally wasn't strong enough to get the near-term line up. Market sentiment's still rising, so that's still pretty decent. The momentum line has been down below 50 now for 5 days, and that's pretty rare. I mean, so that's, that's pretty significant that short-term sentiment has bounced, but hasn't bounced enough to get into the upper half of the chart yet. Again, it's not too common to get such a strong short-term run to the downside, or at least an extended near-term run to the downside and momentum, without a move to the upper half of the chart, and be above the moving average. That was one of the rare instances there, and this would be another one. It's kind of a similar situation that we have going on, where we peak and we just kind of go flat for a while to down before we kind of broke down at the very end, and we'll see, how that plays out here. You notice we didn't close Monday. We didn't close above the September high. We got above the September high last week on the Monday vaccine news. We closed above that high, but then we came back down by Wednesday and stayed down by Friday. And then today's vaccine news didn't get us back above it, so we're still kind of trading below that September high point. So take that for what it's worth. The Dow Jones did get above it on Monday, and closed above it, that September high point, and then has stayed above it, though in a sideways action. So very similar pattern that you can see on this market forecast. The NASDAQ has now gotten the light pink shading and a yellow line. Now, not a yellow line because we are below it, but in this case, a yellow line because it's falling, which is kind of rare. But remember, it's a 30-day average, so it takes in 30 days of movement here. So we're probably taking out some of these days that were up and starting to move it just slightly to the downside. So that's kind of an uncommon situation too, to see light pink shading and yellow line without a close below the moving average. But we got that, and you can see the intermediate line never did get above the reversal zone, and that's why we have the light pink shading already. Now, that's the bearish side, the NASDAQ. The bullish side of things is the Russell 2000, and this is, just like in June here, it's making another run, kind of suckering people in. A lot of people got suckered into the big rotation over here, and then from that point, the NASDAQ really outperformed. Well, now we're doing it again, right? We're kind of really getting suckered off of this low point, and we had a pretty decent run on real estate and utilities to get us up to that high point, well above the pre-September high point. Very similar again to what we saw over here, where we got well above that previous high point there in April, and kind of met that first leg lower high there on the Russell. You can see here, if I were to zoom out, we got up to this high point. This high got above that similar high point and well above that April high, and you can see the S&P got caught up. The Russell had a really big catch-up trade to make, and you remember, we're above the 100% level, but the NASDAQ is well above its 100% level. So still a major catch-up trade to make, and that's what, when you get these kind of moves in small sectors that are abnormally small compared to the biggest sectors in the S&P, which doesn't happen very often, but it happens towards the end of bull markets. It's a sign of a mature, long-term bull markets when you have a big discrepancy in sector weightings, right? At the very end of a bear market, you get kind of some very similar sector weightings. They all kind of come back in line. But we are now about as pulled apart as we were in the late 90s in the S&P 500. So when you're that pulled apart, the smaller sectors don't necessarily lead another long-term bull move, right? They lead catch-up trades, and then the bigger sectors lead the bullish move until we hit our peak and the bear market starts. Then small caps will outperform, but during a bear market, and we're not looking for a bear market anytime soon. So if we're looking for small caps to outperform, you have to rectify those two situations. Small caps will outperform significantly, as you'll see here later in the video, when we're in a bear market. If we're not in a bear market, then if we stay in a bull market, if we want to stay in a bull market, you don't want small caps to outperform. It's okay here and there, but once we pull back, then just like we came off of that low point, just like we came off, all the way to that September 2nd high, you want the Qs, you want the large cap, you want the big tech, the big sectors, which are tech and the Qs. You want them to lead, and they most likely will again once we get through this kind of like overbought clusters and now the potential for a divergence, a near-term divergence coming off of that overbought cluster. So this, again, we might get another day or two of buying, but until you break out of this range on the S&P, this Monday range right here, it's all noise. It's just all sideways noise. And that's a little concerning that we were so bullish to get to the high. We had a really good bullish move, and we have done nothing to follow through on it, at least on the large cap basis. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, click that thumbs up icon. That tells us that you liked our video today and that you want us to do another video again tomorrow. It's a quick way to give us feedback. We look at those every day just to see what you're thinking, how you feel about us. If you don't like our videos, you don't have to click on anything. You don't even have to watch. But if you do like our videos and you want to let us know, we really appreciate those clicks down there. Just one click you can do right now while you're watching. Also, while you're down there, comment. What did you get out of our videos today? What stood out to you? What questions or comments do you have? Post those in our comment section. Join our website at marketscholars.com. There's a link popping out there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content in between the videos. There's my handle right there, at DavidSettle42. And join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, just a reminder to check some of these things out over here on the right. Again, those are all of our classes, including our DGI class, Dividend Growth Investing, a very popular class. In fact, I would say Brandon's probably one of the foremost experts on that that there is. And so, everybody gets, all of our monthly and premium subscribers get access to that class, as well as all the recordings that he's done going back. So very, very good resource for that. That in and of itself is insanely valuable. And then I've got my options class tomorrow. The rest of our classes are on our calendar. Come down here, click on the thumbs up or this heart. It opens up a new window, and hit that like button. There also come over here, hit the thumbs up icon, opens up another new tab. Hit that like button there. Again, the more you do that, it really helps us out because it gets our content out to all of our followers on Facebook and Twitter because it has engagements, it has likes. It's a really big deal for us. That's why we ask for it every day. It's a big deal for you too because Twitter and Facebook will promote content in your timelines from the accounts that you engage with the most. So we try to make it really easy for you to engage with us here. All right, now let's take a look at the weekly chart, and you can see just how strong this PPO again already is. How when it got to this level before, we kind of got stuck there, in that September 2nd high point, and again, same thing over here. We're actually higher than we were pre-COVID, and we are about as high as we were in January of 2018. You also notice too, after getting, like I said, not a very bullish candle last week on the Heikin-Yashi, this would be even worse. So very small body. Right now is the lower close, lower high. So until we break out of Monday's range, this is not, this is kind of a transitionary period, especially with the PPO being as strong. I don't mind, being bullish with a high PPO if you keep getting higher closes and higher highs and we just trend higher. But if we just kind of go nowhere, with the occasional jump to the upside. See, you can do that even over here. We got some over here in 2018 prior to the fourth quarter. We got a lot of this kind of really nothing candles, but we are pretty steadily bullish and we weren't nearly as extreme. The highest we got was near 4% gap between the 50 and the 200. We have a much higher gap than that now, 6.5%. And again, just for some perspective's sake, this to kind of go to show you where we're at 6.44 right now. So if I were to edit this and change it to 6.44, so basically 6.5. Let's go 6.5% here, just to kind of give you some perspective. We hit a 6.5% there in 2018. A little bit there, came really darn close, just like basically where we're at right now in 2013. At that initial peak before this period of volatility came in. Never did test the 200-day. We were well off the Golden Cross there too. Not the same kind of distance off the Golden Cross here. Over here we got above 7% gap coming off of that 2010 Still had a really high VIX there. And then, of course, coming off the major low points. And then even over here. I mean, this is, needless to say, this is very, very significantly bullish for the markets. And it's, a little bit hard to sustain it in the short term, not in the long term. In the long term, great. Or like the next couple of years, great. In the long term, not so good, right? It's small, again, someone said today on TV that small caps is a place to be in the long term. I totally agree. In the long term, like if you were to set yourself up now for the next 10 years, small caps is the way to go. No matter how much more we go up in the next year or two, where large caps are expected, well, I expect large caps will lead. But once we start a bear market, then these large cap tech names will come down the most, and small caps will be your better performers. Just like, so again, I'll show you from 2000 to 2010, small caps just killed everybody. We'll talk about that again here in just a minute. Let's take a look at the 3 green arrow chart. Whoops, excuse me. It's over here. Actually, let's go back really quick to the NASDAQ, the weekly chart for the NASDAQ. So for the Russell, that's what we want to see. And again, don't mind that at all. That's a very strong bullish candle here. Very, very big moves, higher highs, higher closes, big candles. And you can see we are 8.5%. This is the gap between the 50 and the 200-day moving average. Well above the 6% where we're at right now. So huge, huge move that we haven't seen again since 2013. And then we started to grind, but with higher highs. And then again, we saw that in 2010 and 2011. We got up to about 10% there. And then finally, in 2003, the small caps just really killed it. Again, from 2000 over here, small caps really outperformed during that bull market, and I expect that they will again at some point. But not right now where you have such a wide discrepancy. And so something like this is essentially a move from an extreme low to an extreme high point. And once we're done with that move from extreme low to extreme high point, as we saw in June, just be careful because that can correct itself very rapidly. Very rapidly there. Let's take a look at the 3 green arrow charts, and you can see, of course, now we got a red arrow. The MACD has gotten us a red arrow. This is what it looks like in the 2-line version. It's crossed below its moving average. That gives you the red arrow on the MACD. The stochastics is crossed below its moving average, and it's almost down. It's below 80, and getting the red arrow would be when you get below 75. So we are still above the 8-day moving average. Today's move got us back above it after Friday's close. And we're still above the 17. So we're not bearish here, but we're also, as you can tell, kind of losing the bullishness too, losing that strong bullish momentum that we had. So if we are going to maintain bullishness and get a divergence like we're seeing on IWM on the market forecast, then it will be with a kind of a grinding move to the upside. The MACD here on IWM about as high as it's been. The last time it was this high, it was back in June when we got this significantly high here, and we rolled back over and kind of had one last leg up on the histogram before it fell over. We're starting one last leg up on the histogram now, post expiration, before we roll over. All right, now let's look at the intraday chart, and you can really see that sideways range here. I mean, look at that. Like that's last week. Look at the last 3 days. Look how flat the range has been. We're up a little bit today because of, I think, Michigan certified their results. So we're up to 359.27. That's another gap up to the upside. But remember, these common gaps are getting filled in. So if you're bullish, you might not want that, right? You'd probably prefer one to the downside that we can fill in on the way up throughout the day instead of filling it in on the way down throughout the day. So keep that in mind. We're up a little bit here. But all these gaps since have been filled in. And of course, 359 is not anywhere close to 364 where we need to get to. Even last week's high point here is at 362. So we're still, now you have the point of control over the last 4 weeks sitting here at 360. So you have a lot of volume up above us that's going to really kind of sit on top of us. You break through, great. It's going to be really bullish. But if we don't break through, then we're just maintain this sideways action as the high gets gradually more over here to the left and the low stays over here on the left. And that's a pattern that we don't see very often I think I've shown you before, it's the Arun indicator, shows us where the high and the low are in the last 4 weeks relative to the timing of the 4 weeks. So the 0 is the first day of the 20 days, and 100 is the last day of the 20 days. So you can see the high and the low are both moving down towards 0. That's not very, as you can tell over here, that's not very common at all to get that. You can see this is kind of the last time, this last sideways action, and we broke out with an upside move. So, you know, when we've come down both like this together, just like we were coming both down there, we were coming both down there, but then we had a breakout there of an upside move. When we're both going down, that means we're headed towards a breakout move, one way or the other. Last two have been bullish, and we'll see if this next one's bullish. And if you take a look at, you know, some of these other oscillators, like the DMI, you can see the positive index is real strongly bullish, but that negative index is staying very stubborn above 20. So it's kind of hard to get a directional move going, which is what happens when the ADX starts to rise, when we're not getting a drop on the negative index. You look at the Ichimoku cloud, we're well above the cloud, well above the blue line, but you see, and we got a bullish trend going, but it's not able to get started and get really going to the strong side after some really strong moves earlier. The last few bullish moves haven't been anything to write home about, and that continues to be the case. Then you look at the Bollinger Bands here, and you can see the band width is at a relatively high point. I mean, you look, absent this move that we just barely had, but if you look at previous moves, you know, like 2018, here, let me just put, let me change this line, excuse me, to where the bandwidth is now. This is an apples-to-apples comparison, so because it's a relative indicator. So this is where we're at right now. And if you go back, I mean, that's obviously the COVID low point. We got higher, it makes sense. Over here on the Q4 drop, we got higher, that makes sense. The initial Q4 drop wasn't this high on a Bollinger Band move. You look at this this was a bullish move, but then the bearish move is what got the move to the downside here. And then you can see a bearish move, another bearish move, and this is probably the closest in the last 5 years of having a bullish move that expanded it out as much as it did. And you can see what happened after that. So we have a very, very high bandwidth, and now we're trading in the middle of the bandwidth, which suggests, you know, again, at best, we kind of just go flat from here, maybe grind to the upside. At worst, we fill in that gap back down to the downside, towards the lower end of this. As you can see on some of these other moves, we went from top to bottom, top to bottom. You would expect something like that to happen again as we go from strong upper quartile to the middle to the bottom, upper quartile to the middle to the bottom, upper quartile to the middle, and now are we going to go to the bottom here? That's the idea. That's because we're not following through on this bullishness. And what a little follow through we get, like we're getting overnight, occurs overnight. So we end up filling in those common gaps during the day, and we stay sideways. Finally, let's look at the let's look at today's volume and trading range. Below average, well below average up here. So when you look at those numbers on a charted basis, we're falling. So that's not bad. Again, that's why I'm saying we're not like falling off a cliff here. You know, as these fall, that's actually bullish, more so than bearish. It's when we start getting bigger moves, and considering that we've been going here without any kind of significant moves one way or the other, after being a real strong bullish move to the upside, you wonder, you know, where's the equivalent here now with the implied volatility and historical volatility sitting right on top of each other. Something like this, you know, that led to a breakout move to the downside. Now, I'm not looking for a COVID move, but when they're both sitting flat like that, right on top of each other, because the implied won't drop, because there's a lot of pent-up volatility, then see, there's still a lot of pent-up volatility here, then that suggests the market's still worried about a move like that. You can see we're still in the low 20s. We're hovering below 90%, but not really, you know, breaking that down towards 85 and really solidifying ourselves in a bullish category for risk appetite on this volatility chart. All right, so to summarize my technical outlook here before we talk about what's driving today's action, or lack of, for that matter, we maintain a bullish trend, and that bullish breakout 2 Mondays ago has held up. So that's positive on one hand. On the other hand, it's not as positive as it could be because we haven't followed through outside of small caps, which is making a catch-up trade, which we've seen before. And that's a concern, right? So when you kind of see what's going on, like we're not getting the leaders leading. Like, I've always kind of used a comparison in basketball because that's my other thing that I spend a lot of time with. And you think, okay, like when you have a difference in players like your Steph Currys, your Kobe Bryants, there's going to be games where they might not be the leading scorer, and you have a few guys maybe off the bench that are leading scorers, maybe for a few games. But if they end up being your leading scorers over the course of the season, then that means you're having a bad season. The players that got you there are the ones that you're going to lead you throughout the long season. So yeah, right now small caps those are the guys off the bench because there's such a discrepancy between some of these sectors, the bigger sectors and the smallest sectors. And right now they're doing really, really well. They're having a few good games, maybe even outscoring the large caps. But if they end up outscoring us over this long season coming up next year or two, then that means we're going to be in a bear market. That means we're not in a good season. Our leaders aren't leading for a reason. So just keep that in mind. Don't get too worked up behind that move. Just know, again, it happened before in June. And the only reason why it's a little different here is because it's further along. It's a few months later, so we're up higher and we're up closer to, all-time highs for all these indexes. But the idea is still the same now as it was in June. Don't get too worked up in that rotation until these sectors come back into play with each other. And what does it take for those sectors to come back into play with each other? More often than not is a real bear market where there's those valuations for those top sectors come back in line more with everybody else. So what do you think? Do you agree with that? Do you disagree? Let me know. Go down to the comment section there and let me know, especially if you disagree. Tell me why. What are you seeing? What chart or indicator are you looking at that tells you that either you're a lot more bullish than I am, or that you're more bearish, like you're bearish right now and you're a lot more bearish than I even am. I'm looking for. So let me know what you're seeing down there in the comment section. All right, now let's take a look at what's driving this price action. And as I mentioned to you before, again, coming off of that October 30th low point here, right here, and really is coming off of this low point because that's when real estate and utilities did really well. So let's say coming off of 924, so 925. Coming off of that low up until now, small caps are up 25% off of the end of September. Just tremendous moves to the upside. Emerging markets doing really well too. The S&P is up 10%, so it's not too shabby, though it's not really extended itself away from this high that we had in October. And then you can see how some of these other sectors are doing. That's a really, really decent move. And we kind of saw this before. If I were to go back and earlier and coming off of this March low point here, so March 24th, when we were coming off of this low point from way over here, small caps had a really good run from that low. So it was from 514. So 514 going on to that June, was it June 8th? So 514 going on to June 8th. Again, 25% move higher. The S&P was up 14%. So we've seen this before, this trade that we're getting right now before. And just to kind of give you an idea, I went back, I believe it was about the end of May is when IWM first came on. So if you go back, let's just go May 30th of 2000, and you go 10 years from there, May 30th of 2010. Let's go all the way to the end of the month. So 10-year chart here, but on a weekly chart. Again, you can see how, eventually, actually it was right about there in August, August 28th, where things really started to fall over. If I were to go to August 31st, we'll go August, well, we'll do 28th. It's actually the week that ends. Let's see. I believe it's the week that ends, and we'll go to August the 28th over here. So we started down from that point on the S&P and especially on the Qs. Qs started the week strong, pulled back. Small cap stocks held their ground during the drop, and at the end of that 3 years, the tech sector had fallen 75%. The QQQ, had fallen 75%. So the big discrepancy we had in sectors, from technology to the small cap areas, there was so big discrepancy because of the late 90s, had all come back in line. So during the next leg bull market higher, look who led the way higher. Small cap stocks ended up being, the broad market barely got up to its highs in 2007. The small cap stock was up 60, index was up 60% before that peak. And then, of course, we had the financial crisis and everything dropped, and small cap stocks were down 30% from that 2000 high point. It's a pretty significant, not as much as 50%, not as much as 70+%. But then again, 10 years later, the small cap index is up 17%, and while the S&P is down 30 and the QQQs are down 55. So yes, there's going to come a time where you want to be in small caps over the long term, because when the market pulls back, small caps will hold their value better as the sectors come back in line with each other. And as they're more in line and we get a new bull market leg higher, it will most likely be led by something else other than communication services, technology, and discretionary, for that matter. It could be industrials. It was financials there, and then commodities and energy eventually towards the end. So industrials did very well during that time frame too. I think I've shown you in other charts. So it's like now other sectors can bleed over a long term because it's a different team makeup, right? It's almost like now I don't have any established stars on the basketball team, and we have a bunch of young players, and they all have their chance to become leaders, and that's what happened here. And then eventually we had, this bear market that brought the financial sector back where it's supposed to be, and the energy sector back to where it's been, materials back to where. So everything was back in line again, and from 2009, it's been a very cyclical move to the upside, led higher by these big areas. So I think it was 310 of 09 all the way up till today on a weekly chart. I mean, look at that. Like, Qs just end up killing everybody, and the IWM has had their period of outperformance but has been underperforming since 2018, so it's lagged behind the S&P, and the Qs have just taken off to the upside. So there's going to come a time again where those sectors will lead, and that's just not the case, like I say, right now. All right, if we look at how sectors are performing, obviously look at the move that energy's made the last couple of days have really taken off here. But you can tell, like, again, as I mentioned to you before, initially it was energy and utilities and financials. Then utilities really held up really well during the next drop to the low. This is from that September 25th low point. And then now you can see lately utilities been lagging behind, but look what the big winners are. Energy, financials, industrials, materials, and all your big laggards, all your big sectors. Communication services, a little bit of a bounce here in the past week, but they're all lagging behind the market. And again, so you have your guys off the bench who are doing very, very well right now. And we saw this before. Right? We saw this back in, whatever it was here, back in this time frame. So from what was it, 514 up to 68. We saw this before. This is not a new phenomenon. So we shouldn't be tricked by it. If you were tricked by it, it's like, fool me once, shame on me kind of a thing, right? So we've seen this before here, and look how, they were up 30% during that time frame. and there's real estate, and discretionary did okay, but these two, and they did okay too, but they were lagging, and then we saw what happened afterwards, right? So, you know, from 6.9 to 6.26, as I've shown you this chart, I think last time we had our video, they pulled back a lot. The S&P was only down 7%, and the XLK was flat, and they fell 13, 14, 15, 20% because they went up so much. So when does that start? I don't know. But we've seen this play out before, and that's the expectation of something like that happening again. All right, so that brings us to our trade idea of the day. So let's take a look at Best Buy. Best Buy has been on a nice, good bullish trend. Obviously, that bullish trend is slowing. In fact, if you look at the trend strength indicator, it had a really good, strong trend going here, and then it's just been nothing, right? Another little leg higher there, but it picked up some strength. And obviously, we are very much in noisy territory here. We're above the cloud, and a nice, good little move today, breaking above all these highs from the past week. Not breaking above that pre-November 9th high. That's the day that there was announced that we'd have the vaccine, was on the 9th. So we're not above that high yet either. But, you know, you've got a pretty decent trend or upward move. The positive directional index is above 30. The negative index is below 20. So that's the beginnings of a directional move to the upside. Even though, you know, again, you wouldn't expect too big of a move. We're not above 100 here on the CCI. The RSI is barely above 60, and it's actually kind of progressively lower. So we're kind of more going sideways in this action. In fact, if you look at the Bollinger Bands here, you can see we had a relatively large bandwidth right now, and we're just kind of going up and down through the bandwidth. We've got a good volume node here in the lower end of this area from that low on the 9th, and you've got some room to the upside because we have earnings coming up tomorrow. Tomorrow morning. I believe it's tomorrow, might be tomorrow afternoon. But we have earnings coming up on Best Buy, and so we got, and you can see on the earnings before, it doesn't really move post earnings significantly. A little bit of a downside trend there, a little bit of an upside trend on the last earnings here, and of course that's the COVID lower, everything trended lower. So it's like, okay, well, if we're already going sideways going into earnings, and the expectation is we might have a little bit of an upward move, maybe a little bit of a downward move with strong support below us, then let's trade both sides and take advantage of the high premiums because of the earnings announcement. So we'll come over here and we will sell a bull put spread at 111, 106, $5 wide, because on the call side they're $5 wide, so we keep it even. So we'll sell the 135 and buy the 140, and you can see that gives us for a normal risk, even with the earnings, because again, I feel pretty good about where my break-evens are with that earnings announcement. You notice, again, I've got upside here. Best Buy, pull that up here. I've got with the volatility of the earnings announcement priced into this, the market's pricing in a move to 136.5 to the upside, right where my break-even is on the bear call spread. And then I've got a good strong volume node where my break-even is on the bull put spread. So I like my risk management here, so I'm able to go for a normal position size for about a 40% roughly return on that risk. All right, so that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. All of our subscribers, even our free subscribers, get access to that forum. Our class forums are available for our premium subscribers, but the Market Outlook forum is available for everybody. So open up any new thread there, open up with any questions or comments you have, reply to other people's threads, and let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, as well as like us on Twitter and Facebook, and then comment on the video. Have a great rest of your Monday night, everybody, and we'll see you all next time.